Welcome back to GrowthTV. I'm Carolyn Vallejo, and with me today is Scott Linch, who is National Industry Leader of Private Equity at FORVIS. I'm also joined by Bob Dunn, who's Managing Director at GF Data. So let's first off talk about the middle market landscape overall. Are there any notable M&A trends that you both are seeing?
Well, I think when Bob and I first decided to do this, we thought by now surely we would have some certainty in what was happening in the M&A market, but we still unfortunately have a little uncertainty left. And if you just look at what happened in 21 with deal activity at an all-time high, coming into 22, we already had some downturn in deal activity, and it continued into the first quarter, and really driven by a lot of things, but primarily interest rates had a huge impact on it and some of the complications in the public markets in the valuations. But when interest rates are going up so high, there just isn't much more money that people want to invest because they're not able to get the same kind of lending against it. And so in turn, we've seen private equity firms turn to more add-on work or add-on businesses. And I think PitchBook said 72% of all deals in 2022 were add-ons, which was an all-time high. And so being able to do smaller deals because you're not having to get the same kind of leverage on those deals has been what have been keeping people busy. But we are seeing continued activity in getting companies ready to be sold. We're just not seeing as many platform deals as we have historically.
Right.
Thanks, Scott. Thanks, Colin. Yeah, the first quarter, and we're just about out with our reports on it, was very much a mixed bag on it. If you look on the plus side, average purchase price multiple was up to 8 times again after dropping down to 6.9 times in the fourth quarter. That's up on par with where it was for the third quarter. So you see groups willing to pay up, but then deal volume is significantly off, as Scott mentioned, and then cost of capital, I think, is the big story on it. If we looked at average senior debt pricing, it's about 1.5 percentage points higher than what we saw for last year. Similar situation in terms of subordinated debt. The silver lining, I think, is that we have seen, especially in larger deals, firms putting up more equity to cover the lack of senior lending out there. So I think that does speak to a somewhat buoyant environment, and obviously deals need to get done.
Mm-hmm.
And also I think private credit has really stepped in for the traditional banks to fill that void.
Right.
We
Absolutely.
did see a significant growth in non-bank financings in the first quarter, so that does seem to prove out.
Right, definitely. Are there any particular industries where you're seeing a lot of activity right now?
I think healthcare has remained steady. It's a business that everyone needs, and there's just a continuous interest in investing in that market. And it's also an industry that seems to kind of go against the tide a little bit, and when times aren't as good, people do tend to gravitate towards investing in that industry. Business services, anything with kind of that recurring revenue, we're still seeing a pretty big appetite for. The last one I would say is just residential services, things around the home. We're still seeing a lot of activity there.
Mm-hmm.
Yeah, and I guess by the opposite token, manufacturing, we saw some drop in pricing, same thing with distribution transactions. I think that speaks to what you're saying with the recurring revenue really being kind of what you want right now in the current lending environment.
Right. Now I know that when you started this interview, you mentioned that you hoped there would be a little bit more clarity by now, and perhaps there isn't as much as we had hoped. But if we can look out into the rest of the year, the rest of 2023, is there anything that we can come to expect?
Well, one thing's for sure, there's a ton of dry powder still out there on the sidelines. I mean, fundraising also was at record highs as so much deal activity was happening. So there's a lot of funds that have been raised that have to be put to use. And also the cash that's sitting on the balance sheets of a lot of corporations is pretty high. So we're talking trillions of dollars sitting there ready to be invested that people have to invest. We're also, as I mentioned earlier, we're seeing a bunch of activity with our investment banks. They're getting businesses ready to go to market. They're ramping up. So that kind of activity at our firm, we've seen a ton of work on the sell side due diligence. We also have seen a lot of work from our investment bank on taking companies, owner operator, entrepreneurs, taking their businesses to market. In succession planning, they're not as worried about the interest rates as we are, because they're ready to exit their business and move on with their life. So a lot of those folks have made that decision. And so we're seeing the activity ramping up, and then the money's sitting there. So it just lends you to believe there has to be a pretty big pickup in the back half of the year, towards the end of the year, going into the first quarter of next year.
Okay.
Yeah, and I would only add that, I kind of considered the fourth quarter to be the end of the COVID deal cycle. And at the beginning of that, early 2020, I think there was a lot of speculation about how could the industry continue on, how could you do these things without being in person, at site visits, that sort of thing. But it ended up being one of the busiest periods we've ever seen. So I think the optimist in me says that, we'll find a way around this also, and that the deal cycle will pick up.
Wonderful. Optimism. I love it. Scott, Bob, thank you so much for joining Growth TV.
Our pleasure.
Yeah, thank you.